Hello, dear students. We are about to start our new session on the course of investment project management. So let us allow a few minutes more for the audience to join. Meanwhile, I will share the screen. We have started session 9 last time about negotiations of terms and conditions in the course of setting up project finance. And we touched the concept of project company and its founding documents like development agreement, shareholder agreement. And also we discussed about the different roles the sponsors could take within the project company and how they can source the staff for the project company, and proceed to the topic about working with the main counterparty in the course of getting project finance. It is a commercial banks, and today we'll start with discussion about the structure of commercial banks, its departments, responsible parties, etc., etc. So we have now 5 participants. Okay, probably we should move on. Those who are not present now will be able to hear the records of this session. And also I would like to announce that similar to the course of alternative investment projects, we will have half of next session devoted to the mock exam that will help you to prepare for the final exam and can also be counted at the second homework. So please pass this information to your fellow students. I would like to invite as much as they can to join the last session in this course. So let us go to discussion about the commercial banks and its structure. Most commercial banks in the project finance field have specialist departments that work on putting together project finance deals. There are 3 main approaches to organizing such departments. The first is have a project finance department. And the longest standing approach is to have a department purely specializing in the project finance transactions. Larger departments are divided into industry teams covering sectors such as infrastructure, energy, and natural resources. Concentrating all the project finance expertise in one department ensures an efficient use of resources and good cross-fertilization, using experience of project finance for different industries. However, it may not offer clients the best range of services. The second approach is a structured finance department. The divisions between project finance and other types of structured finance have become increasingly blurred, and therefore project finance often forms part of a larger structured finance operation. Again, there may be a division into industry teams. This approach may offer a more sophisticated range of products, but there is some danger that project finance may not fit easily into the operation of other businesses is based on a much shorter time horizon. For example, if LBOs, so that leverage buyouts, are also dealt within the same department, and we can recall that the average time for the project with leverage buyout involved is from 5 to 7 years, and sometimes it's reached only 15 years. And the last approach is to have an industry-based departments, and it is to combine all financing for a particular industry sector, for example, electricity, natural resources, or infrastructure. And if this industry makes regular use of the project finance experts form part of the team. This provides one-stop service to the bank's client in that particular industry, but obviously may diminish cross-fertilization between project finance expertise and different industries. In the end, good communication and cooperation with the bank are probably more important than the formal organization. In general, the project finance personnel in these departments have banking or finance backgrounds, although banks may also employ in-house engineers and other specialists, including people with relevant industry experience. Even though most of the personnel are not expert in construction, engineering, or other non-financial disciplines, by working on a variety of transactions over time, they develop expertise and experience in various industries and the technical and practical issues that can affect the viability of the project. However, banks also rely extensively on specialized external advisors. Project finance is a time-consuming process for banks and uses well-qualified and therefore expensive staff. Some past market leaders have withdrawn from the business because the bank has come to the decision that a better return on the capital can be obtained from other types of structured finance or from concentrating on corporate lending or retail banking. Projects need to be of a reasonable minimum size to provide banks with enough revenue to make the time spent on them worthwhile. Arranging debt for a project much under, say, $25 million is unlikely to be economic, and the most major banks would prefer to work on the projects of, say, 100 million or more. And I can assure from my own experience that pretty the same in our local banking industry too. For example, we approached several top 5 banks in Russia for the project finance, and yes, there is some minimum amount of financing that can incite a bank to participate in such a financing project, and it's about from say $500 million rubles, so it's roughly 5 to 6 or even $7 million. But of course, it's slightly different figures that for the global market, but that it is. Still, the structuring of project finance is very expensive and time-consuming process, so banks should consider the effectiveness of involvement in such a project on the basis of the cost of the staff too. And as a standard approach to arranging a project finance loan is to appoint a bank which will ultimately underwrite the debt as a lead arranger. As with financial advisor, experience of lending to the type of the project and in the country concerned are key factors in selecting a lead arranger. A wider banking relationship with one or more of the sponsors is often another element in the decision. Lead arrangers' fees are predominantly based on a successful conclusion of the financing, although there may be a small retainer, and advisors and other all out of the pocket costs such as travel are usually covered by the sponsors. Larger loans may require more than one bank to underwrite the financing. This has become more common since the crisis of 2008 as a result of pressures on the bank balance sheet and the decline in a syndication market, resulting in sponsors having to appoint several lead arrangers who will underwrite the debt on a club basis, which is in effect a pre-syndication of the loan. The result may be the appointment of some or all of these banks as joint lead arrangers. In major projects, both the financial advisor and the lead arrangers may be appointed separately at the early stage to provide more balanced advice, although obviously this adds to development costs. The financial advisor or a lead arranger acting as a financial advisor plays an active role in the negotiation of project contracts to ensure that the financing implications of these contracts are taken into account. Any changes in the project contracts that are good for the sponsors are generally good for the banks too. And so, lead arrangers are sometimes used by sponsors to improve their commercial position in these negotiations. And we have a letter of intent. Banks commonly provide letter of intent or letters of interests to sponsors early in the development of the project. They are usually short, only 1-2 pages long, and confirm the bank's basic interest in getting involved in the project. If this letter requires the sponsors to deal exclusively with the bank's concern, this may amount to a lead arranger's mandate letter. Alternatively, the sponsors may collect a number of such letters from different banks. Letters of this nature provide the sponsors with initial reassurance that the financing market is interested in their project and help to give the sponsors credibility with other prospective project contracts counterparts, such as fuel suppliers, product purchasers, contracting authorities, etc. Such letters should not be regarded as a legal commitment on the bank's part. They are primarily used by banks to ensure they keep their foot in the door of the project. But on the other, a bank does not issue such a letter previously. A mandate letter is normally signed between the sponsors and the selected lead arrangers, which expresses the bank's intentions, subject to, to due diligence, credit clearance, and agreement on detailed terms. So, intentions to underwrite the debt required. Some indication of pricing and other debt terms may also be given, although this may be difficult at an early stage of the transaction. This mandate letter does not impose a legal obligation on the bank to underwrite or lend money for the project. If the lead arranger are also appointed as a financial advisor, the mandate letter will also provide for services similar to those of the financial advisor. The mandate may be combined with the term sheet, depending on how advanced the project development is at the time. Then we have a financial model. The development of the financial model should ideally be a joint operation between the sponsors and the financial advisor or lead arranger, probably with each assigning 1 or 2 people to work in a joint team. And from my own experience, the usual approach is to both have a separate parallel model developed either by project team or financial institution, and then have a joint financial model that serves as the integral point for getting finance. So both models, either from project team or financial institution, finally should lead and comply with this integral model for the project. This integral model is used as a reference point for all issues we will discuss later in detail, such as the amounts of the funds that can be drawn down, the actual KPIs that should be met by some specific dates, etc. So it's a two-way process of that can be started in parallel on both sides, but ultimately lead to one joint integral financial model. And I have a term sheet. The financing structure develops. A term sheet is drawn up, setting out in a summary for the basis on which the finance will be provided. It is preferable for term sheet discussions to concentrate on commercial rather than the legal issues, although the dividing line may be difficult to draw. The final term sheet should provide the basis for lead arrangers to complete their internal credit proposals and obtain the necessary approvals to go ahead with the loan. The work of a bank's project finance team, and the consequent proposal for a loan is normally reviewed by a separate credit department and may be presented to a formal credit committee for approval. Banks must have a well-organized interface between the credit team and the project finance team, especially where a bank is acting as a lead arranger. It may take a long time to develop a project finance transaction, and if the loan is turned down at the end of the process on the credit grounds, that obviously has serious consequences for the sponsors and has not helped the bank's project finance team very much. On the other hand, a bank cannot obtain credit approval at the beginning of the development process because the structure of the transaction will probably not sufficiently finalized. The sponsors, therefore, need to have a confidence that the lead arranger has the experience and credibility to manage the internal review process. And finally, we have the signature of the term sheet that is still normally no more than a moral obligation, as the commitment by the banks is usually subject to further detailed due diligence of the project contracts and associated documentation, and signature of financing and security documentation. Nonetheless, a term sheet is treated seriously, and banks normally only withdraw from underwriting if there is a major change of circumstances, either in relation to the project itself, the country in which it is situated, or the market in general. On the next phase in a financing is the negotiation of financing documentation, and based on the necessary due diligence, securing the bank's agreement to the project contracts which provided security. It is quite likely that as a result of these detailed negotiations, change in the lending terms or risk profile may arise, which will again require credit approval. So it's a iterative, repetitive process, but shrinking in the terms of a variety of details to be discussed, finally leading to one common single set of the documents to sign. That's how the commercial banks are organized within, and what is the general steps in the process of securing project finance. But still, it can differ substantially from on the case-by-case approach, and the time horizon for such a process of negotiation can take as much as years, but definitely it's not a weeks, but rather on average several months, because again, the project finance are huge projects that need a substantial amount of financing with a lot of risks derived from the nature of the income source, that is the contracts of the project, and the lenders who should secure the loans should also investigate these project contracts in detail. And let us now proceed to a very lengthy and complex session about the financial structuring. That is a core process you as a financial analysts and financial professionals probably would involve too. So we'll examine some of the main financial structuring issues likely to arise when the commercial fundamentals and risks of the project have been reviewed. We assume that financing is being provided by commercial banks, but for the most part, similar principles are followed by the bond market, as well as other types of private and public sector lenders or guarantors. Financial structuring would normally proceed in a parallel with the financial modeling process. Since the sponsors are the drivers for any project, the investor's point of view will be discussed first. The main elements likely to be dealt with in negotiations between the project company and the lenders on the overall financing structure and terms. That is, debt cover ratios, debt equity ratio, debt service profile, interest rate, and fees, and additional costs. These are all interrelated, so that a change in one requirement will usually lead to a change in one or more of the others. Therefore, these interrelated effects need to be taken into account through further optimization of the financial model to produce the most efficient financial structure. It should be borne in mind that there is no merit in innovation for the sake of the project finance. As is evident, there is a highly complex form of financing, and innovative financing structures may just add to the time and cost of putting the deal together, or to be rigid if something goes wrong, and extra risks that cannot be foreseen at the beginning. These financial structures should therefore be kept as simple as possible. For example, several different sources of debt should not be used, and sufficient finance can be raised from one source. And it is far quicker and easier to deal with one group of lenders. And I should say from my own experience, if even such a very important issues like establish a hedge in some projects, establish a hedge against the risks of a foreign exchange, currency foreign exchange. So if you're getting the money, say, for a project that is operable in a Russian Federation and gets revenue in rubles, but was financed with a debt nominated in both in euros and dollars. And probably it's a very good approach to have an additional hedge for this currency conversion risk. But from my own experience, I should say that if this hedge involves too complicated processes of discussion with counterparties that provides a hedge, the memorandum of that is proposed by the third party to establish a hedge is so complex that the sponsor cannot grasp the idea or be clear about in which cases the hedge works and in which is not. It is no rational for them to enter such hedge, even it is a normal practice to have a hedge for currency conversion risk. So again, please keep in mind that this simplicity is a good, and there is no rationale for the use of some modern and complex financial vehicles for the sake of the efficiency of the project. So let us discuss about the key performance indicators and the structure of the equity and the investor analysis that can be employed. A minimum equity IRR is the most usual measure used by sponsors and other investors to determine whether a project investment is viable from their point of view. However, equity in this context is usually a blend of share capital and subordinated debt. The timing of the equity investment is important as it affects the investor's return calculations. Other measures of return on investment may also be used in a parallel with equity IRR. So what is the equity IRR? The equity IRR is calculated based on the cash return on the cash equity investment. So if the equity is invested, say, over a 2-year construction period, each sum invested is taken into the IRR calculation as and when the investment is made. Similarly, it is not when the project company generates cash that matters for this IRR calculation, but when that cash is paid out to investors. There may be a considerable gap between these 2 points because the lenders typically require cash to be held back in reserve accounts with payments to investors twice a year, based on the half-yearly cash flow results. Project finance investors use the return on the equity investment and the project company as their main measure. Investors usually have hurdle rates for the equity IRR, above which an investment is acceptable and below which is not. The hurdle rate is generally fixed based on the investor's own weighted cost of the capital. The additional return over cost of the capital required for particular types of risks, which would be influenced by, for example, type of project, location, extent to which risks are hedged by project agreements, extent to which the investment adds or diminishes the spread of risk in the investor's portfolio, etc. Also, other factors are market competition in cases where the prospective sponsors are bidding for a project in a public procurement, especially, and project viability. Even if the project is not subject to a competitive bid, the product or service provided should itself be competitive, which would not be in a case if our equity IRR is too high. So probably it's also a sign of a bad economic and commercial framework you set up for the project if your equity IRR is too high compared to the average on market. So probably you inflate this IRR using too optimistic pricing models, etc. That again indication of risks, and you can default in a sense of getting the right revenue. Setting a required return rate for the risk based on the project's company equity IRR is circular in nature, because the equity IRR is dependent on the level of leverage, which is itself dependent on the risk. Indeed, it could be argued that equity IRR is simply an arithmetic product of the lender's debt cover ratios. Yeah, probably so. And we will see it in the calculations in this lecture. Market rates for equity IRRs have developed in industries where projects are frequently put out to investors for bidding by governments or other off-takers, especially a project with a processing plant setup, and public-private partnership projects. Equity IRRs in projects with moderate risk, such as a power project with power purchase agreement, or in infrastructure projects with limited usage risks, located in a low-risk countries, tend to be in a range of 12 to 15% per annum. That is a pre-tax and on a nominal basis. That is including inflation in the cash flow projections. This is relatively low compared to returns in some other types of equity investment in new ventures, reflecting the lower level of risk. And arguably, however, the return is still high considering the limited risk. Higher returns up to 20% per annum may be seen in a project with high risks, for example, traffic risk, and also in the developing countries or in the new project finance markets generally. Okay, and we have a blended equity IRR. In many projects, the shareholders' investment is mainly made by way of a subordinated loan rather than in a share capital. In fact, the project company's share capital may be quite minimal, say $100 or 10,000 rubles as in Russia, with the rest provided as a subordinated debt at an interest rate close to the required equity IRR. The subordinated debt is normally stapled to the equity shares. That is, the proportion in which they are both held cannot be changed, and if one is sold, the other may also be sold pro rata. This is done for two reasons. First, to avoid the dividend gap, and second, because interest payment on the shareholder provided debt are tax deductible for the project company, whereas dividend payments on share capital are not. So the normal measurement for investors is actually not a simple equity IRR, but the blended equity IRR. That is a return taking both the return on their shareholdings and on their subordinated debt together. If the structure is used, typically in the early years of the project, the investors receive their return mainly by way of debt service on subordinated debt, and only in the later years of the project are substantial dividends paid. The payment of dividends and debt service of a subordinated debt are collectively known as distributions. Lenders generally do not concern themselves whether their equity is subscribed in shares or subordinated debt. All distributions are controlled in the same way. Because subordinated debt is so common in projects, the lenders are often called the senior lenders to distinguish them from the investors as subordinate lenders. The blended equity IRR is typically calculated post-tax. That is, after allowing for a tax paid by the project company, but not taking any account of the investor's individual tax positions. However, if most of the equity is subscribed as tax-deductible subordinated debt, the pre- and post-tax IRRs will be quite similar. The financial model for the project should not assume that cash is retained if it could be paid out as distributions. If this is done, it will distort the blended equity IRR calculation and any payments based on this. Similarly, if the investors later choose to leave cash on the project company rather than pay it out as distributions, these should also be disregarded for calculation purposes. So that is like a financial modeling mistake if you have in your financial model additional income stream, like the investor leaves the cash available for distribution on the account of the project, and then you put this money on some deposit, and you have additional interest surplus that you receive putting the money on a deposit, and then you add this income stream to calculating the efficiency for investors. It's a mistake, and it's misleading mistake, because the calculation of IRR, you recall this in discussions from 2 sessions previously, suppose by its nature that the investor who receives the income stream can reinvest its money at the same level as IRR. So probably if you're putting the money on the deposit account, you cannot get the same amount of return as the project itself, and you in this way overestimate the actual efficiency for the investor. So please keep in mind this simple approach to have a sound and not misleading financial model from the investor's point of view. Okay, let us have a short break for 5 minutes, and we will proceed with the topic about the timing of equity investors. Let us meet in the 5 minutes at 1:42. And if you have any questions right now regarding the course, the session, or general questions, please raise a hand or type in the chat. Meet you in 5 minutes. Okay, we are back again. And let us discuss the timing of equity investment. There are several possibilities as to the timing of equity investment. That is, when the investor's share of the total funding is drawn. So first, before any drawings on the debt service or the debt finance. That is, at the beginning of the construction phase. Pro rata with drawings on the debt finance. That is spread throughout the construction phase, and after any drawings on the debt finance, that is towards the end of the construction phase. Most investors calculate their IRR, equity IRR based on cash investment, not on the funds they have at risk, but have not yet invested in cash. This means that the later the equity is invested, the higher the equity IRR, because the investment is being repaid over a short period, which makes investment at the end of the construction phase the most attractive in IRR terms. The only disadvantage of not contributing the equity before that is that project costs are increased because of the need to fund more interest during construction. If there is any difficulty in raising the marginal amount of debt funding required for this, for example, because the total funding available is limited, or because only tied funding that goes not fund interest during construction is available. So in this case, the sponsors may have to go first. Lenders would obviously prefer the equity to be invested first, but will not normally object to the debt being drawn first or pro rata, so long as the sponsors are legally committed to invest the equity, though the equity subscription agreement, and will do so immediately if the project goes into default. Bank guarantors and bank guarantees or letters of credit may need to be provided as the security for this uncalled equity. Thus, the investor's risk is the same whether the equity is invested early or later. And we have a very specific facility called equity bridge loan for investors who want to squeeze the maximum IRR benefit out of the timing of their cash flow, cash equity investment. An equity bridge loan can be provided by lenders. This is a loan to the project company for the amount of equity secured by corporate guarantees from the sponsors. So no risk is being taken on the project by equity bridge loan lenders. This loan is used to cover the equity share of the project costs, and at the end of the construction phase, the real equity is finally paid and used to repay the bridge facility. If there is an equity bridge loan, this is usually drawn before any senior debt because it is cheaper. For example, let us switch now to the Excel. Give me a few minutes. So I will share now the Excel. We have this calculation. I will also provide you with the spreadsheets. So, for example, we have this structure finance with these parameters like project cost, debt to equity ratio, etc. We'll discuss it in detail later, but now we should have a sense of the effect of the timing of the cash flow repayments on the final efficiency parameters. So if the annuity repayment structure financing used, it is assumed that the equity is invested at the end of the construction phase. You can see here, with loan repayments and dividends beginning 1 year later. Here, loan repayments, dividends, you can see. In fact, the equity IRR would only have been as high as 90%. That is shown here with annual annuity repayments. If we use this facility called equity bridge loan, as otherwise equity would have to have been invested to cover project costs before the end of the construction phase. If, on the other hand, the equity is assumed to be invested at a rate of 15% at the start of the year 2, and 50% 1 year into construction, the equity IRR reduced from 90% to 40%. So please consider this timing of the cash flows. And drawn equity can be taken into the equity calculation quite easily by assuming, for calculation purposes, that it is drawn one day, so in one single day of the project, not distributed in a period, and earns a cash return equivalent to the investor's cost of the capital until it is in fact drawn by the project company. This more accurate measure for the return on the investor's real risk, but is not generally used by investors, just as more accurate modified IRR or MIRR calculation is not used either. I provide here the both measures for you just to feel the difference between the calculation is using only IRR and MIRR. The result is that when the boards of the sponsors approve equity investments in a project, this may be based on an exaggerated or overestimated idea of the equity return. So the difference between IRR and MIRR is that while IRR suppose that your cash inflows can be reinvested at the same rate, the MIRR have the different rate for reinvestment of the cash flows that you can receive, representing the actual costs of opportunity you have. Okay, we'll return to these calculations later. So again, please feel free to navigate through all these calculations and see how the timing of payment affects the final figures for IRR, and how the various measures for IRR can also affect the calculations. Now let's switch to the presentation. Okay. Let us refresh and recall the various measures of efficiency of the project we discussed in the probably 3 or 4 lectures before. So given the problems with using equity IRR, many investors do not use it as a sole measure of whether an investment should be made in a project finance transaction or not. Other measures are used as further checks to ensure that the IRR measure does not recommend an unsuitable investment. And we have a net present value, so the investor's hurdle rate of return can be applied to the cash flows as a discount rate, and if the result is a positive NPV, the investment can proceed. We have also additional measure called NPV at risk. It could be, however, argued that adjusting for risk in NPV discount rate is an oversimplified approach. Many factors affect the investor risks, and therefore looking at the range of outcomes could be more realistic. So rather than increasing the hurdle rate for risk, it would make more sense to use a risk-free hurdle rate, the investor's own cost of the capital, and apply this to the range of risk-based cash flow scenarios for the project, which can be calculated using Monte Carlo simulation. This approach, known as NPV at risk, produces a range of probabilities for NPV outcome, and the investment would be made and if the range of highest probability outcomes have an NPV over 0. And I have a suggestion for you. So probably if you don't want or unable to use a Monte Carlo simulation in a very specific project, please at least have a sensitivity analysis table for IRR and PV, depending on the various factors, at least like sales or revenue or costs changes or interest rates changes. We already touched that sensitivity tables in the previous sessions, so we can probably address the example of this cogeneration project and see how this sensitivity analysis tables looks like, and probably it can be also used as some proxy for calculating NPV at risk if you do not have an ability to use Monte Carlo simulation. We also have a payback period, and if the final analysis cash in a king for any investors, there is a rule for that. So it is relevant to know how fast the investor will be paid back. Investors may require that any equity investment also has a minimum payback period of no more than a certain number of years. That is the length of time that it takes to recover their original cash investment. This is a crude measure. In particular, it does not take account of returns after the end of the payback period. Nevertheless, it still provides a useful check against projects which offer a high equity IRR that do not produce adequate cash distributions for a long time. A refinement of the payback period calculation is a discounted payback period. Let's calculate the period of time it takes to recover the original investment based on the NPV of the future cash flows being discounted at the investor's cost of the capital. This takes the time value of money into account as a part of calculation, which the simple method does not. Let us look at the calculation and switch back to the Excel again. We have this example SAS 10.1. It gives an idea of both methods of calculation. For the payback period calculation, it can be seen that in year 4, the cumulative total of the cash flow becomes positive. The payback period is therefore 4 plus the difference between 450 and 200 divided by 450, that is 4.6 years. For the discounted payback calculation, the cash flows are discounted at the investor's cost of the capital. In this case, it's 8. And then the payback period is worked out in the same way, producing a discounted period of 5.1 years. So probably both measures are good and produce close results, but the discount payback period is more correct, while the simple payback period is very simple for the top managers, so the people who decide either to invest or not, to understand. We have also profit investment ratio, and it compares the NPV of future cash flows with the initial investment. So and this table, the NPV of the future cash flows discounted at 8% is 1,617, and the initial investment is 1,000, given the PI ratio of 1.6 to 1, and an investor can therefore establish a minimum PI ratio as another investment measure, which is more useful than the NPV calculation. Come back to the presentation. Operating margin. Companies also inevitably look at how the investment in the project will appear in their published accounts, as well as these cash flows based calculations. A standard measure here is the operating margin, that is net profit as a percentage of revenues. An investor may therefore require a minimum annual operating margin of, say, 12%, as well as minimum equity IRR. So it's again, it is some KPI that can be set by investor on the operational efficiency of your business. So you should not only repay all the debt back, you should not only provide the minimum required return on the debt, but also you should assure your lenders that you have sufficient efficiency level and operational level, so your operations are good in the nature, not taking into account any leverage you used, etc. So your operational business should be profitable enough to produce a surplus income cash flow to repay the debt. That's the idea behind these measures. And the project IRR. The project IRR is calculated from the cash flow of the project before debt service and distributions. Measured as a return on the cash flow and on the cash investment required. This is sometimes done at the early stage of development of the project to check its robustness without taking account of its particular financing structure. Otherwise, the project IRR has limited relevance in the project finance context, where one or main point of leveraging the project with debt is so improve the equity return. And so a measurement of the return on the project without leverage is not that relevant. However, it can be used as a discount rate to value the project, for example, on early termination. It may also be used for investors who have a portfolio of corporate finance and project finance projects to compare one project with another. So we can see that the lenders or investors erect a set of these hedges or fences or hurdles for the project to pass, meaning that they should be insured in a 360 degrees manner about the viability of the project, its financial efficiency, and all other things. And that lead us to the very important investors and lenders point of view, ratios. There is a debt cover ratios. The level of debt that can be raised for a project is based primarily on its projected ability to pay interest and repaying loan principal installments as they fall due with a comfortable margin of safety. To assess this margin of safety, lenders calculate cover ratios, that is, various ratios between operating cash flow and the level of debt or debt service, namely annual debt service cover ratio, ADSCR, loan life cover ratio, LLCR. The averages of the ADSCR and LLCR over the term of the debt and the project life cover ratio, PLCR, or the reverse cover ratio for the natural resource projects. It's very important ratios, and they heavily used if the finance is provided you via debt. The higher the coverage ratios, the greater the margin of safety for lenders. It should be noted that none of these cover ratios can be calculated for a period before the project company begins operating, and that the calculations are based on cash flow, not accruals. So you should calculate using cash flows, not anything when there are some costs, profits, but not actual cash flow associated with them. So you have to adjust all your projections for non-cash, either additions or subtractions. Let's discuss it in detail. Annual debt service cover ratio. The ADSCR assesses the project company's ability to service its debt from its annual cash flow, and is calculated as net operating cash flow for the project over the year, that is operating revenues less operating expenses, taking account of any maintenance reserve account or similar reserve accounts covering anything other than the debt service, and ignoring any non-cash items such as accounting depreciation, and that is all divided by debt service of the project over the year, that is interest payments and principal repayments, ignoring transfers to or from debt service reserve accounts. Please note in mind these types, three types of accounts I presented to you here: maintenance reserve account, other reserve account similar to the maintenance reserve account, and debt service reserve account. It's very important accounts set up by the lenders on the request of lenders to provide some cushion for the investment. Thus, if operating cash flow for year is 120, interest payments are 55, and loan repayments are 45, the ADSCR would be 1.2. So simply divide by 120 by the sum of 55 and 45. The ADSCR is usually calculated semi-annually on a rolling annual basis. The ratio can obviously only be calculated when the project has been in operation for a year, although because it may affect the ability to pay dividends, it may be calculated for the previous 6 months only for the first period after the project begins operations. And we see in this simple calculation a figure for ADSCR is 1.2. I should say it's not usual, for example, at least in Russia for such type of projects. Most of the lenders require this ratio to be at least 1.3 or not to fall below 1.3 for any 2 consecutive periods. The lenders look at the projected ADSCR for each period throughout the term of the loan and check that is does not fall below the required minimum at any time. The actual ADSCRs are reviewed and projections for the future ADSCRs may be recalculated while the project is in operation, because you will know the things better since you started operation. The minimum ADSCR requirement obviously varies between projects. Higher risk projects requiring a higher ADSCR and vice versa. Very approximate levels for standard projects could be 1.2 for an accommodation-based project, 1.25 for a process plant project with an off-take contract. So when you have a contract that assures the purchase of your of the product and services of your plant, 1.5 for a natural resources project with no off-take contract. So you extract something, drill something, but you have no agreed and signed contract to sell the results of your drilling. 1.75 for a transport concession, and that is the point I mentioned previously. I have in mind experience the transport concession, but with a lower ADSR requirement, like I already mentioned, 1.3, and 2.0 for a merchant power plant project with no off-take contract or price hedging. So recall our cogeneration project, if we will have no off-take contract or no price hedging, so no adjusting it for inflation, etc. This will lead us ultimately to a higher ADSR levels. Higher coverage levels would be required for a project with non-standard risks or located in a country with a poor credit risk. Then we have a long life cover ratio. The long life cover ratio is based on a similar calculation, but taking over the whole term of the loan. So projected net operating cash flow calculated as the same manner as for the ADSR from the date on which the project is projected to begin operations to the date at which the loan is repaid, and discounted to its NPV at the same interest rate as that assumed for the debt, and divided by debt outstanding on the calculation date, less the balance of debt service reserve accounts. Other reserve accounts should not normally be included in the calculation. It may be argued that free cash balances that is not in any reserve accounts should either be deducted from the debt in the LLCR calculation or added to the NPV of cash flows. But if these balances are intended to be used for distributions, it is doubtful whether they should be counted in. So there is a lot of separate special reserve accounts that is also associated with the project. And if you have already established some distribution accounts, so you already allocated some funds to distribute to investors either in forms of interest payment or loan repayment or dividends, they should not already be included in a calculation of your coverage ratios, like loan life coverage. You already assigned these payments to be paid off. So the minimum initial loan life cover ratio required in a standard project is around 10% higher than the figures shown for a minimum ADSR. So just plus one from 10 to 15 basic points to these figures. And apart from the initial LLCR on the project completion, the LLCR may be recalculated throughout the rest of the project life, comparing the projected operating cash flow for the remainder of the loan terms with the remaining loan outstanding on the calculation date. LLCR is a useful measure for the initial assessment of the project's ability to service the debt as a whole and for continuing to look at it over the remaining life. But clearly, it is not so useful if there are likely to be significant cash flow fluctuations from year to year. ADSR is thus more significant measure of a project company's ability to service its debt and its full due. And we have an averages of these ratios. If the projected ADSCR from year to year is at the same level, the average ADSCR will be the same as LLCR. However, if the ADSCR is higher in earlier years, the average ADSCR will be higher than the LLCR and vice versa. Therefore, average ADSCR is sometimes given more weight by lenders than LLCR as a long-term measure of coverage. If so, the minimum requirements are likely to be similar to those for LLCR. And average LLCR, that is recalculating LLCR every 6 months for the remainder of the loan, and then taking the average of these figures, is also used as a measure by some lenders, although its usefulness is perhaps questionable. Yeah, for me, it's not obvious what is the gains of using this average LLCR, not really in practice. Project life cover ratio. Another point that the lenders check is whether the project has capacity to make repayments after the original final maturity of the debt. In case there have been difficulties in repaying all of the debt in time. This extra debt service capacity is known as the debt tail, and lenders normally expect at least a year or two of cash flow cover in this way. This is achieved by ensuring that the project agreement runs for a period of X years after the scheduled final debt repayment date, so providing a debt tail of X, during which the cash flow continues to provide the lenders with extra security. The extra security to lenders provided by the debt tail can be calculated using the project life cover ratios. Here, the net operating cash flow before debt service for the whole life of the project, not just the term of the debt as for LLCR, is discounted to its NPV. And this figure is divided by the debt outstanding. Obviously, the PLCR will be higher than the LLCR. Lenders may wish to see it's around 15 to 20% higher than the minimum ADSCR. A standard rule of thumb is that the reverse cover ratio should be 2 to 1. Based on the lender's conservative projection of the commodity prices, and obviously not less than 1 to 1 in downside price projection. Let me give you an example why and what for it used. So we have this project of leasing the bus fleet from leasing company and providing public transportation services in one city, and we have a lease term of 5 years, and we have a contract term with the local authority also for 5 years, and probably the long life, that means that the all lease should be repaid within the 5 years, because we have the remaining book value for all these buses leased at some very minimum level, so we can consider it 0. So they fully amortized for 5 years, so and the lease fully repaid in 5 years. But we have this ADSCR, as I mentioned, 1.3, but we have really high project life cover ratio, nearly 2, as I mentioned previously. But what point was made? Because there is a risk that the local authority can revise its contract, probably because there can be some cases filed against the concourse, the tender, or on if it goes well, they just want to extend the contract because they want to the public transportation services provided for more 5 years. In that case, the lender should be assured that the project can continue and will not experience the problem of finding new buses to lease or to conduct some repairments or replacements for existing bus fleet at this time. So again, the lender want to be assured for the rest of the project, the expected rest of the project, that the amount of free cash flow available for the debt service is still enough to continue for at least to continue the repayments and the debt service if it is will be extended for all project life. Okay. Should we have a break for 10 minutes because the next will be a topic regarding calculation. So no objections to have a 10 minutes break until 2:30, okay? So if there's no objections, let us have a break for 10 minutes. We'll meet at 2:30. Okay, welcome back, and let us start with example of calculation for such ratios and a typical project. So in this table, we have a typical project with a level annual cash flow before debt service of 220. Here we have 1,000 loan, and it is repaid in equal annual principal installments over the 10 years. Interest rate of the loan is a 10% per annum. That is the same rate that is used for NPV calculation. If it is assumed that the project generates 200 per annum of cash flow for a further 3 years tail period after the end of the loan, for example, this year's 11 to 13, the NPV of the total 12 years cash flow is 1,499, and so the initial PLCR is 1.5. Let us see the calculation here. We have the loan repayment, we have the interest payment, and the total debt service. That is the, you can see here, calculate, oh, sorry. Probably something went wrong with the license, no problem. We have the operating cash flow divided by the total debt service and lead us to the ADSR. We have the average for the ADSR, that's average for the years that passed. And we have the LLCR, that is the NPV divided by the loan understanding, and the same for average LLCR for the rest of the life. Okay, switch back to the presentation. Let us discuss some issues in calculating these cover ratios. One of is the taxes, and this issue in calculating of this ratio is whether tax payments should be deducted from the net cash flow before debt service, especially when calculating the ADSR, since a variation in interest payments also affects the tax payments. It may be prudent to do this if there are wide variations in taxes paid between one year and another. For example, because of the effect of accelerated tax depreciation allowances, which should be taken into account. The argument against this is that taxes are only paid after deductions for interest costs, which are not included in the operating cash flow figure. Although significant fluctuations in a tax between one year and the next can be dealt with by placing cash in a tax reserve account. However, so long as the inclusion or exclusion of taxes is taken into account when deciding what the ratio levels should be and dealt with consequently, the choice of approach is not too important. And in respect of comparison of project finance and corporate finance, it should be noted that unlike corporate loans, the cash flow cover ratio for annual interest, as opposed to the total debt service, is not generally considered a significant measurement. This is because corporate loans are often renewed, whereas project finance loans have to be repaid because the project has a finite life. Therefore, the project company must be able to reduce its debt each year as scheduled, and payment of interest alone is generally not adequate. Similarly, corporate finance accounting ratios such as the current or liquidity ratio are generally not used in the project finance. Short-term liquidity is dealt with through the establishment of reserve accounts. Minimum cover ratios and the debt amount. Cover ratios are often a key factor in determining how much debt a project can raise. We can see again it on the example. So in this example, it is assumed that the project produced 1,000 per annum of the net cash flow before debt service over a 25-year period. If the lenders require a minimum 1.5 ADSCR, this means that debt service cannot be more than 667. That is 1,000 divided by 1.5. Here it is calculation. You can see. This means that assuming the debt service is repaid on an annuity basis at an interest rate of 6% per annum, 8,522 of debt can be raised against this project cash flow. That is paying back 8,522 of debt on an annuity basis over 25 years at an interest rate 6 equals $667 in each year. So just reverse calculation from your projected annual free cash flow, then given the set annual debt coverage ratio, you go to the actual amount of cash that can be used to cover both debt, principal of the debt and interest payment. And if it is an annuity-based payment, then using reverse calculation here, you can arrive at the total maximum principal for the debt. However, if the required ADSCR is reduced to 1.25, this means that the maximum annual debt service increases to 800, and respectively, that can also be increased to 10,227, while still observing the required minimum ADSCR. So you can see that it's very important figures that can affect the maximum debt load for the projects heavily. A high ratio, let's switch to the presentation again. A high ratio of debt is the essence of the project finance. Within prudent limits, therefore, sponsors wish to limit the amount of equity they invest in a project and thus to raise the maximum level of debt. The cover ratios, especially ADSCR, are a key factor in determining how much debt a project can raise, and hence how much equity will be required if there is no other source of finance for the project costs. And therefore, lenders typically work backwards from the cover ratio calculations to set the debt equity ratio, rather than prefix debt equity ratio. So following the pretty same procedures that we have in a previous example, you're in this, from your debt coverage ratios, you can understand how much debt you can employ, and that's finally will lead you to debt equity ratio. And having said that, the debt equity ratios which result from cover ratio calculations reflect the risk of the project. So the higher the required cover ratio, the greater the safety margin for lenders. But as we see in the previous example, the lower the amount of debt which can be raised, and the projects with a greater risk have lower debt equity ratios. For example, they have 90-10 for accommodation-based contracts, 85-15 for process plant project with an offtake contract, 80-20 for a transport concession, and I should say that was really the figures I had in my project with this public transportation project. 70 to 30 for a merchant power plant project with no offtake contract or price hedging, and it is some average for the market now, and 50 to 50 for a natural resources project. It should also be borne in mind that the debt equity ratio is not a constant figure. In fact, the set ratios above only apply to one time in the project life, that is the project completion. Thereafter, the debt is being regularly repaid more slowly than the equity, which is repaid over the full term of the project agreement, including debt tail period. And so the proportion of the debt will reduce over the project life, eventually reaching zero, all being well, at the beginning of the debt tail period. What about calculation of debt and equity ratio? Once the debt equity ratio has been fixed, lenders will require this ratio to be adhered to. The point at which the project company is normally required to demonstrate that it has met the required debt equity ratio, assuming that debt and equity are not being drawn down pro rata, is the later of project completion or the date on which no further drawings can be made on the debt. The calculation is based on the cash injections of debt and equity, not whatever appears on the balance sheet. And if more than one currency is being used for funding, the calculation should be based on the exchange rate between these currencies at financial close. And we have very specific cases of projects without equity. If a project has a high degree of certainty in its cash flows, thanks to a project agreement that transfers the price and demand risks, and high ADSRs and LLCR, arithmetically, it may need no equity at all and still have enough cash flow to support 100 debt financing. Generally, however, lenders wish the sponsors to be at risk with a reasonable amount of equity in the project. And given the requirement for cover ratios, arithmetically speaking, there must always be a surplus cash flow above that required for debt service. That must be used somehow, and the obvious use is paying for equity return. Moreover, it is important that the sponsors have an investment risk during the construction phase. And if there are no sponsors, who is to manage the project? Some projects have been financed with pinpoint equity, that is a nominal amount of equity required by some legislations. But these are really exceptional cases. Okay, what about the debt service profile? Debt service, that is a loan interest payments and principal repayments, is one of the biggest factors in the financing structure that influences an investor's rate of return. And the faster investors in a project company are paid dividends and other distributions, the better the rate of return. Investors, therefore, do not wish too much cash flow from operation of the project to be devoted for repayments to lenders at the expense of these distributions. Lenders, on the other hand, generally wish to be repaid as rapidly as possible. Striking a reasonable balance between these conflicting demands is an important part of the loan negotiations. The issues that come up in negotiating the debt repayment schedule are the term of the financing, its average life, the repayment schedule, and flexibility in repayment. What about the term of financing? In general, project finance debt is much longer in term than normal bank loans. A power project may have a 2 to 3 year drawdown period during construction and then 15 years of repayment, giving the total return of debt for 17 to 18 years. An infrastructure project finance may be for 25 years or more. Financing for natural resources and telecommunications projects is usually shorter in term. However, taking account of the shorter life cycle of such projects, for example, a mining claw may be as short as 5 years, but another factors here is that the leverage is usually around 50 to 50. So there is less debt to pay off. And of course, this depends on there being a financing market which is able and willing to provide the necessary term of debt. The term, so probably you want to have a term loan for 25 years, but there is no such a proposal on the market. No one is willing to provide you such a long-term loan. The term of the financing depends mainly on the long-term certainty on the cash flow of the project, taking into account the need for the debt tail. Thus, a project company with 20-year project agreement may aim to raise debt for 70 to 90 years. The cover ratios are all, of course, affected by the debt service schedule. The shorter the term, the higher the debt service payments. And the lower the ADCR and LLCR requirements. And so, if the debt is made too short term, it cannot be supported by the cash flow. So if you compress your debt term, you have probably so high early total debt service payments that you cannot afford. Probably you should consider more long-term debt. And another factor that may affect the financing term is the location of the project. If it is in a high-risk country, the term of the financing will usually be shorter than the same project in a low-risk country. The notional term of the financing may be lengthened by the use of cash sweep arrangements. Please know this notion of the cash sweep arrangement. We'll discuss it later in detail. And we have an average life. Apart from the overall term of the loan, lenders also look at the repayment schedule to assess how rapidly their risk reduces over time. There is obviously a considerable difference in risk between a loan of 1,000 repaid in 100 installments over 10 years and a loan of 1,000 repaid in one bullet installment at the end of 10 years. So preferably, obviously, the lenders prefer to receive money back as soon as possible, not to wait for the end of the loan. And lenders may have an average life limitation, that is maximum average life, as a part of their overall credit policy towards project finance loans. And so it may be necessary for investors' distributions to be slowed down and debt service speeded up to maintain the required average life. The average life is measured by looking at the loan average life, which is used by lenders in a similar way to the payback period calculation by investors. That is a check to ensure that the repayment schedule is not overextended. That can be calculated in a variety of ways, based on the period of time until half of a loan has been repaid. So in this approach, if a loan of 4 is repaid over 4 years in annual installments of 1, the average life would be 2 years, because at that point half of the loan have been repaid. So just when the half of the loan is repaid. Then we have another approach, that weighting the loan principal outstanding for each year by adding these together and then dividing by original loan amount. Thus, for the same loan, the average life on this basis would be 2.5 years. That is, for year 1 we have 4 years understanding, for year 3 is 3 years understanding, etc., etc., etc. So we have 4 plus 3 plus 2 plus 1, all divided by 4, lead us to 2.5 years. And we have weighting the repayments by multiplying each installment by the number of years outstanding and dividing by loan amount. For the same loan, these calculations will be like 1 times 1 plus 1 times 2 plus 1 times 3 plus 1 times 4, all divided by 4, which of course produces the same result. A weighted calculations is more appropriate because it takes account of the repayment schedule. Suppose the loan of 4 was repaid as 2 at the end of year 2 and 2 at the end of year 4. The simple calculation would still give this an average life of 2 years, the same as with 4 annual repayments of 1. But the weighted calculation will give you an average life of 3 years. So making it clear that it has a longer weighted average life than the loan repaid by equal annual installments. However, this calculation is made more complex in the project finance context, as project finance loans are drawn down over a period of time during the project's construction phase. So in such a case, how long is each drawing outstanding and how can this be averaged? So let us switch again to the Excel. We have this table with the average life calculation with construction period. So there are 3 ways of dealing with this. First, ignore the drawdown period and look only at the average life of the repayment. And the second, add the whole drawdown period in a calculation of the average life of the repayment period. The argument for this being that the lenders are on risk for the whole of their loan during the drawdown period. Thus, a loan of 4 with annual repayments of 1 were drawn down over 2 years and then repaid in equal installments over following 4, its weighted average life would be 4.5 years. So 2 years from drawdown when we construct something, and then the 2.5 years weighted average life for the repayment, as we calculated previously. And we have using weighted loan principal outstanding method, with the denominator of the calculation being the peak loan principal outstanding. Here it is. Though this becomes rather problematic if loan principal outstanding revolve, that is, go up and down, because being drawn, repaid for some other cash flow, and then drawn again. So if a loan for, you can see here, loan for drawn over 2-year construction phase in 2 installments and the end of each year. So here loan outstanding at the end of year 2, 1 is here year 2. and is repaid in 4 annual installments of 1 at the end of next 4 years. The average life is 3, as shown in this table. You can see the calculations, which can be compared to the 4.5 years calculated in using the previous approach, when we just add all the bunch of the years for the drawdown to the average life only for the repayment period. So you can compare the different approach used to calculate the average loan life, and you should consider what approach is applied by your lender and which limitations the lender have in their portfolio context. Okay, let's switch back to the presentation. Oh, sorry, I haven't shown. So here's the Excel file again, please have a look. We have 2 years we have a drawdown the loan, +2 in the first year, +4 more in the second year, etc. Then we have an outflow. So we repay the loan for the next 4 years, and the calculation, that is the total loan outstanding by the maximum drawdown in this period. So for the total loan divided by the maximum drawdown is 4. Okay, come back to the presentation. There is various measures to calculate the long term and average long term, but what about the repayment schedule? And come back to the examples we already started. Loan repayments usually begin around 6 months after the construction of the project is complete and are usually made at 6 monthly intervals. Where bond financing is used, a sinking fund may be built to repay the whole amount of the bond on its final maturity rather than making repayments in installments. But this obviously adds to the financing costs and is not common in the project finance bond market. Hence, project finance bonds are normally amortized or being repaid in a similar way to loans. So no rationale really to accumulate the funds needed on a sinking account and then repaying the bond in one installment, in one bullet payment, rather to have regular repayments and amortizing the bond. As to the repayment schedule and structure, it may be thought that the fairest way to deal with lenders, assuming the project cash flow is reasonably over the time, would be to repay the financing in equal installments. For example, if debt service is 1,000 and it is being repaid over 10 years, repayments would be 100 per annum. In fact, this repayment structure, although not uncommon, is disadvantageous to the investors in the project company, as far more of the cash flow is being paid out to the lenders in the early years of the loan, because the interest payment are relatively high at this stage. It also leaves the project with a lower ADSR in the early years, just at the time when project cash flows is more likely to be affected by startup problems. The standard approach is therefore to use an annuity repayment structure, which keeps principal and interest payments level throughout the long term. This can be illustrated by simplified examples in the tables. It is the results, and I will switch again to the Excel. We start our lecture with these examples, and again, let's see closely. So we have a project cost of 1,250. We have a debt equity ratio of 80 to 20. We have a loan amount of 1,000. We have repayment that 10 years annually in arrears. We have an interest rate of 10% per annum. We have equity amount of 250. So cash flow before debt service and dividend payments are 220 per annum. Cash flow after debt service is all paid out to investors, so nothing left on the project company. Residual value of the project is nil. Investors' NPV discount rate, cost of the capital is 12%, and investors' reinvestment rate for MIRR calculation is 12% also, so no problem with that. The calculation ignores any construction period. An immediate and obvious problem with the level principal payment structure is that the annual debt service in a year 1, 200, is almost double that of the year 10, 110. So you have the level repayment of the loan, and in the first year, the highest interest payment. So the highest total debt service here. And correspondingly, the ADSCR ratio is 1.1, too low for comfort in year 1. You can see here, and it equals 2, really much higher than probably needed in a year 10. So really uneven distribution of the values for ratio and the total debt service between years. Investors' distributions, on the other hand, are heavily backhanded, with dividends increasing by 5 times between year 1 and year 2. It takes nearly 6 years to pay back the original investment. You can see it here, how much left for the debt repayment and what is the actual payback period. The benefits from the change in repayment to an annuity structure are self-evident. The ADSCR is comfortable at 1.35 throughout, thanks to the level debt service payments the same as the LLCR. The dividends are also level throughout, and although, let's see this annual annuity repayment, you can see here, and although the total dividends received by the investors over the life of a project reduced from 650, you can see the total flow for the investors is 650, and it reduced to 573, but the timing has changed and the investors' IRR improves from 16.6 to 18.8. However, the improvement in modified IRR is favorable reflection of the picture is more limited from 14.6 to 14.9. The back pay period reduced significantly to within 4.5 years. So from 6 here we have rounding, but it's 4.5. It's rounding here. Okay. The repayment structure is relatively more important to the investors than the interest rate on the debt. If in this example, the lenders offered to reduce their interest rate by 0.25% in return for a level principal payment structure instead of an annuity repayment, the IRR benefit of this to the investors would be 0.6%. Whereas the annuity repayment structure, it is worth an extra 2.2% per annum. Similarly, it is likely to be worth paying a higher rate of interest to obtain longer-term financing if there is a sufficient cash flow tail to allow this. Let us literally check this approach. So remember, this equity IRR is 16.6. If we reduce the interest rate, you can see easily here we have now more equity IRR of 17.2% and with difference of 1.6%. But actually, the switching from level repayments to the annuity repayments improve the IRR most substantially by 2.2%. So please, again, you can use these spreadsheets to play with the figures and to see how it works. So all we discuss here can be tested using the spreadsheets I will send you to. And however, an annuity repayment structure considerably increases the debt service payments and so reduces the ADSCR in the later years of the project. It also increases the average life of the debt. You can see in this table, the average life of the debt is 5.5, while here with annuity payment we have 6.3. So it's less attractive for lenders, and probably we can have some difficulties in negotiating this debt and this debt schedule if the lender has some limitation on the average life of the loan. So it's all these ratios are very important in the negotiation of the loan. As there is much uncertainty about the later cash flows from the project, lenders may look for higher cover ratios and a shorter average life that can be achieved with an annuity payment. A compromise between level principal payments and annuity repayments may need to be agreed in such cases. On the other hand, as the project is projected to produce higher cash flows in later years, a repayment schedule with loan installments being paid even more slowly than an annuity structure, but with adequate annual cover ratios could be feasible, although lenders resist too much the ending of the repayment and hence an unduly long average life for their loan. If irregular cash flows are projected, the loan repayments can also be structured on an irregular schedule, such that the same level of ADSRs are maintained throughout the loan term. This is known also as sculptured repayment schedule, and I should say that it's really often and heavily used in practice. So probably the sculptured repayment is a more common approach for the project because it's allowing the more flexibility and of course to squeeze more money both for lenders and for investors from project. This may be necessary, for example, if there is a large maintenance cost in 1 year, or if after-tax cash flow in the later years decrease because deferred taxes start becoming payable, if the project company has benefit from accelerated tax depreciation on its assets in the early years of operations, assuming that these blips are not smoothed I would buy advance payment in reserve accounts. These considerations are not only relevant to investors. The debt repayment structure clearly affects the cost of the project's company products or services and may be a crucial factor in sponsors are in a competitive bidding situation for a prospective project. Okay, that's for schedule issues and ratios. And we will now proceed to the discussion of interest rate and fees, but I'd like to give you and myself a short break for 5 minutes. So please have a rest, refresh yourself with a cup of coffee and or tea, and we will meet in 5 minutes. Okay, let's move on. What about interest rate and associated fees? The main financing costs payable by the project company are, if a loan is on a floating interest rate basis, the base interest rate, previously it was LIBOR, plus the interest margin, together with net payments under interest rate swaps. Or if a loan or bond is at fixed basis, an interest rate and advisory, arranging and underwriting fees, commitment fees, agency and security trustee fees, lenders advisors fees, and credit rating agency fees if a debt is rated. Let's discuss it in detail. Interest rate. International project finance loans are at a floating rate based on some base rate, typically have interest margins in a range of 2 to 3.5% over that rate. Pricing is usually higher until project completion, reflecting the higher risk of the stage of the project. Then drops down and then gradually climbs back again over time. Thus, in a project with a loan covering a 2-year construction and 15 years operation phase, the margin might be 2.5 for years 1, then 2% for years 3 2, then again 2% and a quarter percent for years 8 and 13, and 2.5 for the rest of the project. These known as a margin ratchet. Where a floating rate margin applies, interest rate hedging will also be put in place. Many banks now split the quoted margin internally between two factors: the balance sheet liquidity effect of the loan and the charge for the credit risk. The latter is retained by the project finance department, while the former is paid to the bank's treasury department, which deals with rating the necessary finance for a loan portfolio. So you also should understand how the proceeds from the loan is split and distributed within the bank, accounted within the bank. If fixed rate lending is being provided, the rate may reflect the cost of funds for III borrower plus a small margin to cover administration costs and further margin to cover risk. The coupon rates for other type of fixed rate lending, including bonds, are based on similar factors to those that affect the pricing of interest rate swaps. Bond coupon pricing is usually quoted as a margin over the current yield of a government bond with a similar maturity to the average life of the debt, and reflecting the current yields at which similar bonds are already trading in the market. Then comes arranging and underwriting fees. Arranging and underwriting fees charged by bank lead arrangers are derived from several factors: the size, the complexity of the financing, the time and work involved in structuring the financing, the risk that a success-based fee may not be earned because the project does not go ahead. So that to some extent the successful deals subsidize the failed one. The next factors is the bank's overall return targets for work of this kind, taking into account both the fees earned and return on the loan balance that it keeps on its own books. The length of time of the underwriting bank has to carry any syndication risk. For a variety of reasons, there can be often a considerable time lag between the signing of loan documentation and enhanced underwriting and syndication to other participating banks in the project finance market. And the last, the proportion of the fee that has to be reallowed to sub-underwriting club or participating banks to induce them to join the financing. So some against some free money to incite other banks to participate in a syndication. Roughly speaking, the overall level of fees is about the same percentage as the interest margin. If the arranging bank is also acting as a financial advisor, this may increase the fees around by 1%. The considerations affecting bond arranging and the underwriting fees are much the same, except that the investment bank's underwriting the transactions does not usually intend to retain the bonds on its own portfolio, and therefore does not take this into account in assessing return. Also, the period of risk on a bond underwriting is much shorter than for bank syndication. Bond underwriting fees are therefore significantly lower than those from comparable loans. And also we have a commitment fees. Commitment fees are paid on the available but undrawn portion of the bank debt during the construction phase. That is so long as drawings may be made on the loan but not made. In a project finance loan, commitment fees are usually around half of the interest margin. As most project finance loans are drawn very slowly, taking from 2 to 3 years in most cases, banks need the commitment fee to give them a reasonable rate of return on their risk during the construction of the project. So the concept of having this commitment fee is that the bank takes on the exposure to the risk of the project. So the bank is ready to provide the finance. So it finds the funding, and the funding is not for free. So at any call for the capital, the bank should provide the funding. But if you are not calling the capital, not the drawings loan, so what is the legal base for the bank to charge you anything instead of the actual drawn amount of money? No. So for that reason, the bank is charging for on the basis on undrawn amount, and it's really very close to the interest rate margin. And agency fees. Finally, there are the agency fees payable to the agent bank or security trustee. The time that the bank has to spend on agency work can be quite considerable, and it is in the project company's interest to ensure that a reasonable annual agency fee covers this work adequately. But this fee should be based on a fair assessment of costs and not a major source of extra profit for an agent. So please keep an eye on these costs. And what about the actual process of getting to the final financial structure? It is through the process of optimization. A process of optimization of the financial model is carried out by the sponsor of financial advisors to find the best possible structuring combination to produce the best equity IRR or the best bid in a tender or public procurement. This process is illustrated in a simplified form in the next Excel spreadsheet I would like to share with you now. So I will switch. I have this table, and we'll have several cases that was considered. So let us discuss in details. Case 1 assumes a project cost of 1,000, that the lenders will lend up to 95% of the cost, but also require a ADCR of 1.35. The loan bears an interest rate of 7% and is repayable on an annuity basis over 25 years. Given these assumptions, the annual debt service is 82, and the annual distributions to investors would be 7. So contract payments are 88 per annum, which would be needed to pay these sums to lenders and investors. However, the project also has to satisfy the lender's requirement of ADCR not less than 1.75. So you can see here the calculations are for the debt service. That is the formula here for annuity payment, then the distributions, and the final contract payment. Since the annual debt service is 82, the contract payments have to be 110. That is 82 multiplied by 135 to satisfy this ADCR. So even though the lenders and investors would be received the required debt service and distributions with the annual contract payments of 88, the contract payment is forced up to 110 because of a cover ratio required. So you need to have more substantial income stream to cover not only the actual needed debt service payments and distributions to investors, but just to satisfy the ADCR ratio. And that's why we go to the case 2. Therefore, this case assumes that the leverage had been reduced to 85, and all other assumptions are the same. Counterintuitive as it may seem, these reduce the required contract payments. The total of annual debt service and distributions is now 95. The contract payment to satisfy ADCR requirement is also 95. That is 70 multiplied by 1.35. So you can see here, so we have with this lower proportion of debt used, you have lower debt service on the basis of annual annuity calculation, you have lower distributions, higher distributions, and you have the final contract price of 95. That fits the requirement of having enough cushion to allow ADCR of 1.35. So now the coverage ratio is no more than is needed to meet the required annual debt and equity payments. What comes next? Case 3 assumes that the lenders are willing to reduce their ADCR to 1.25. This also enables the lenders to increase the ratio, debt equity ratio, to 86. The total of annual debt service and distributions now 93. The contract payment to satisfy the ADCR requirement is also 93. That is 74 multiplied by 125. So a reduction in the cover ratio produces a lower contract payment. In fact, it may be more beneficial to the sponsors to negotiate a lower cover ratios and a lower debt interest rate. So you can see we lowered the cover ratios and we increased the debt equity ratio. All others leave pretty the same. So we haven't in this case to increase the contract price. So it's a very good approach. But what comes next? Case 4 assumes that the investors are willing to provide more equity and also to reduce their required equity IRR. Similarly, the debt interest rate is reduced to 6.5, reflecting the lower risk now there if we provide more equity. So more equity investment, lower the interest rate. What comes out? The total of annual debt service and distribution now again pretty the same figure, 91, below the previous case. So again, quite paradoxically, a substantial reduction of the leverage may reduce the contract payments. Therefore, there has to be some qualification of the statement that the higher leverage necessarily produce a lower cost for a project, product, or service. However, one problem with this approach for an off-taker contracting authority is that this structure makes it easier for investors to refinance the project with high leverage early in the project life, which is financially inefficient from the former's point of view. In summary, the objective is not necessarily to produce a lower cost of debt finance for the project company, but to arrive at the lowest weighted average cost of the capital. That is the total financing costs, taking debt finance terms and costs and equity return requirements into account. These illustrations of model optimization are highly simplified. The calculations ignore operating revenues and costs, which can be assumed to be the same in all of the cases, as well as inflation and tax and lenders' requirement for a project tail. And other factors which may affect the cash flow, such as maintenance spikes, are also ignored. So at this moment, we finished with the section, the topic devoted to the financial structure, and we have a very interesting topic left for the next session. It's called the financial close and monitoring, and I will also discuss with you the approach if we'll have part of the next lecture for you to pass a mock exam. So is there any objections about it? So probably we will have an hour and a half, depends on a number of questions for you to pass, just to fill the pace of an exam, to test the questions and try to fill in. I will not send the mock exam here because we will pass it online during next lectures. That's the idea. You should feel the environment of the exam, so you will be given the live try to pass the exam. It will be substantially shorter than the actual exam. I will be with you on this exam. We will discuss some issues if there will be, but the idea is to try to pass an exam, but on a limited basis, on the basis of a limited number of questions, and it should be done online. So for that reason, I'm kindly asking you to tell the story to all your fellow students and invite them to join the next session. In this respect, do you have again any questions, objections, etc.? Please tell me, we'll discuss. Okay, so I will let you make up your mind a few minutes more. Meanwhile, I will prepare an open slides for next session. Probably we should start discussing these issues now to have more time for the next lecture and for mock exam. So just a few minutes. Yeah, Alona, I will forward the Excel spreadsheet along with the slides for this lecture, so no problem. And let us have to start the discussion about this financial close and monitoring issues to save the time. So we have some time left, so let's move on. And I will share now the presentation. So what we have a term sheet that is have to be signed to arrive at financial close, and it contains a lot of key terms we should be aware of. So it's a very extensive list, and the lender's term sheet sets out as a summary of the main commercial and financial terms and structure the lenders are offering, and in due course serves as a template for the financial documentation. The terms and conditions usually covered by the term sheet are listed in this table. I will not repeat all these key terms, but please use this table as a reference when we will discuss anything or will come across some terms in the spreadsheets in your professional life. But we will discuss some more important and the main concept of the term sheet, the availability period. The availability period is a period during which the debt is available for drawing. If not fully drawn by the end of the availability period, the commitment to advance any further debt is terminated. And typically, the availability period runs until the earlier of 6 months after the actual project completion or 12 months after planned project completion. Then we have a drawdown procedure. The procedure for drawing the loan usually involves the project company presenting a formal drawdown request several days in advance of the date on which funds are required. Both equity investment and loan drawings are paid into disbursement account in the project's company name, over which the lenders have a security interest, or they are paid directly to the beneficiaries, especially the constructor contractor. And very important concept of debt accretion. In some cases, the project company may be able to use a borrowing-based system of a drawdown to finance separate tranches of investment, and when cash flow or other targets have been met. Debt accretion is a drawdown structure closely related to a borrowing-based system, under which the debt can be drawn during a much longer availability period. The most common used relates to concessions. And this type of a project lenders usually take a conservative view of the likely buildup of traffic. Therefore, if over time the traffic increases above these projections, more debt can be drawn on a pre-agreed cover ratio formula based on the growth of the user fees. The availability period in such cases may be extended to, say, or the first 10 years of operation. However, a similar result can also be achieved by refinancing the original debt when the traffic growth allows, but it's also better to have the debt accretion provision within your financial term sheet. So, what are the conditions precedent to financial close? Even the financing documents and the project contracts are signed, and they should be either be simultaneous. The sponsors have not yet finally obtained committed financing for the project company. Even at this stage, the banks may not actually provide the finance. There are numerous conditions precedent that have to be fulfilled before allowing a drawing to be made. When the project has reached this stage, that is, conditions precedent have been fulfilled, and the project company is able to begin drawing funds for construction, the project has finally achieved financial close. So what are the conditions precedent? Signature of the financial documentation alone does not mean that the lenders will start advancing funds to the project company. In order to draw down any debt at all, the project must first reach financial close. This is the date at which all project contracts and financing documentation have been signed, and the condition precedent to the effectiveness of the lender's commitments have been satisfied or waived. The conditions precedent are effectively a checklist of documents the lenders require as the basis for their financing. When these are provided, the lenders are obliged to advance funds. This does not mean that the lenders have no obligation before that date. For example, if the financing documentation requires the lenders to keep information about the project confidential, this is effective on signing. So what are the conditions precedent to financial close? The list of conditions precedents or CPs documentation for a project finance loan can be of immense length, often running into several hundred documents and certificates. I will just start with discussing, and probably will start the next lecture with refreshing the idea of conditional precedents and its list. The typical requirements by lenders, all of which must be satisfactory to them in a form or content, include corporate documentation. That is, corporate documentation, board resolutions, legal opinions, etc. for the project company, evidencing that it is properly constituted and able to enter into financing. Similar corporate documentation for any other parties to project contracts or financing documentation, and providers of guarantees, bonding, and other security, and assigned copies of shareholders' agreements relating to the project's company. Then we have a project documentation, evidence of a title to or right to use the project site, signed copies of all the project contracts, and evidence that all the CPs have been fulfilled and they are in a full force and effect. Contract guarantees, bonds, and other security. Permits for the financing, construction, and operation of the project. Signed direct agreements. Agreements for construction of third-party facilities and connections. Then we have a financing documentation. It is a signature of all financing documentation. Bank loan agreement, agency agreement, or bond terms and conditions and trust deed. Fee letters covering payments of arranging and underwriting fees. Any sponsor support service agreements and guarantees, or parent company guarantees for some contractors. Security documentation, registration of this security. Financial due diligence documents. Evidence that all investors' funding, equity, or subordinated debt has been paid or committed, and any security for this is in place. Evidence that any other parallel financing arrangements are in place and effective. Evidence that interest swap or other hedging arrangements are in place, either have to be concluded immediately at financial close. Evidence that the project accounts and other banking arrangements are in place. Evidence that the required insurance is in place. Up-to-date financial statements for relevant parties. And we have a technical or commercial due diligence documents. It contains financial reports from the lender's engineer, insurance advisors, and any other advisors. The financial model auditor reports, including report on tax aspects of the project. Final construction and funding budget and drawdown schedule. Banking case, so final case financial model that is agreed with bank. And finally, set of legal due diligence documents that contains legal opinion from lenders, lawyers, and some jurisdiction also from borrowers' lawyers as to the validity of the documentation. Confirmation that no event of default had occurred, and the confirmation that the project company is not subject to any litigation. Some of these CPs are circular in nature. In such cases, the legal advisors to the various parties arrange a simultaneous closing of the documentation. Some CPs may not be achievable when the loan documentation or project contracts are signed, and so a distinction may be added between CPs which are available at signing and conditions subsequent, which have to be fulfilled before financial close can be reached. If it is the case, the original signing may be referred to as a dry closing. The period between the signature of loan documentation and the final achieving financial close can become very lengthy if not well managed. It is the sponsor's responsibility to manage this process effectively, preferably by gathering as much of CP documentation as possible in advance of loan signing to ensure the minimum delay between financial close, before financial close, sorry. Agreeing to CP documentation before signing the financial documents also ensures that no one expects the surprises from issues raised by lenders after the loan has been signed. Let us stop here. It's a very heavy topic here, a lot of new concepts, a lot of new content. Please digest it. We'll start next session probably with answering on your questions regarding the course, regarding the material, and refreshing the concept and ideas about the financial close. So by far, do you have any questions on the course? Probably some suggestions, your ideas, please share. I will also send the slides as well as the Excel spreadsheets to you. So if there is no questions so far, I would like to thank you for the time and wish you a good weekend. So thank you. See you next time.